All right, you guys, today we're going to talk about how to hedge a portfolio. This question I get asked a lot, and I've tiptoed around the idea of actually making this video because so many people try to hedge a portfolio incorrectly. And before I wanted to go out giving advice on how to hedge a portfolio, I really wanted to make sure that I can put this out there in the clearest possible manner. This is going to just be a very basic video speaking about different instruments that you can use to hedge a portfolio, whether it's a long-term portfolio or a trading portfolio that you might have. If this is something that interests you, comment down below specifically what instrument you would want me to do a deep dive video on, explaining exactly how I would hedge a portfolio with one of these things that we're going to talk about. Now, before we get in it, hit the like button, subscribe to this channel, hit the notification bell. I do have a public stock market group on Discord. It's completely free. The link is down below if you want to hang out, come trade with us, maybe see what I'm investing in and trading in. It's a great community to be a part of, guys. Now, let's talk about how to hedge. And there are really 5 main ways that you can hedge. And we're going to start with the most boring, really, but the easiest to start with, the easiest for you guys to understand. And that is going to be with gold. Now, when we talk about gold, this could be gold bricks. This could be a gold ETF, either one of them, but many people hedge their portfolios with gold because it lacks credit or the default risk that many of these other, investing instruments have. So gold prices go up usually when interest rates go down, which is directly proportional to the strength of the economy. So in a broad sense, gold is essentially a hedge against a failing economy. Now, like I said before, you could actually go buy gold bricks, like actual bricks if you wanted. I think right now one brick is like $56,000, which is not, what I would be doing, but there are a lot of good gold ETFs, and gold has always been a good hedge. And if you look, like I bolded out here, it lacks credit or default risk. So what exactly does that mean? Well, when it says it lacks default risk, think of it like a bond, which when we go over a bond later on, one of the most important things if you're investing in bonds is that you want to get a government issued bond, because if you don't get a government issued bond, it doesn't happen much, but whatever source you're purchasing that bond from, that company could go out of business, or whatever that bond is coming from could end up defaulting on the bond, because a bond is just an IOU, right? If you wanted to get a bond from me, Peter DiCarlo, I could sell you a $100 bond for 3 years from now for $200, and you only get that money if I actually pay you back. So the good thing about gold is that there's no contracts, there's no business that you have to hope ends up doing its job and can pay you back your money, or any bond that whoever the debtor is, they can pay you back. The good thing with gold is you just buy it, and most of the time when the economy goes down, gold does go up. Now, the second one is crypto. I'm specifically talking about Bitcoin right here, but a lot of people like to hedge against inflation, hedge against a failing market with cryptocurrency. And the reason that people like to do this with Bitcoin, and a lot of their proponents have said for a very long time, it's a great hedge, is because the network has a limited amount on the number of units that can be created. So one of the biggest issues with the US dollar, the reason that many people don't believe in the dollar, the reason that a lot of people like myself think that the dollar will collapse probably within my lifetime, is simply for the fact that the US dollar is not backed by anything. And this is very, very basic. So if you guys already know this, stay with me, but it's always good to rehear this. But the US dollar is not backed by anything. In 1971, we took it off of the gold standard. Prior to that, every single dollar that was printed was backed by an equivalent amount of gold. Now it is not backed by anything. In theory, we could just print as much money as we possibly want, which is basically what we're doing right now. And the only thing that would deter us from that is massive amounts of inflation. If you guys want me to do a video on inflation, because it is something that is really hurting our economy right now, and I think that will be a huge problem for the economy within the next couple of years as well, growing threat, I can do a video on it. So comment down below if you want me to. But the reason that the blockchain and Bitcoin itself has so much value to so many people is that you can't just make as many coins as you want. That in theory, well, not in theory, but in practice, you can't create as many coins as you want. There's a set amount, and that's what gives it its value. Now, the third thing is bonds. Bonds are really, really boring. I don't really end up hedging with bonds most of the time. I really don't. But government bonds are very secure. Like I said, it's an IOU, and you want to use government bonds. I put this in the notes here, but it's an IOU specifically from the government saying that for, lending us money, we are going to give you X return at X time, and they don't ever really fail. So it is a good way to try to hedge against the market, because what you have to realize, I didn't talk about this earlier when we were under crypto, but big money never sleeps. Big money, the whales, the biggest investors in hedge funds in this world, they do not just sit on cash most of the time. Most of the time, they're constantly moving their money, whether it's moving it from sector to sector, so from like tech to industrials to energy to financials, or moving it from instrument to instrument, such as gold, crypto, bonds, ETFs, options markets, which we're going to get in later on. Big money never sleeps. It never stops. It rarely that a hedge fund's going to pull everything out and go 70-80% cash, right? Like that doesn't happen. So bonds is a good one that you can also use, but I don't really mess with them. The next one, inverse ETFs. I have done videos on TQQQ and SQQQ, but that was a very, very long time ago. I have this in my notes. I'm going to do some videos this week and next week on specific inverse ETFs and some of the issues and some of the ways that you can actually use to hedge. But with an inverse ETF, it is essentially just an ETF like you would see normally, which if you guys don't know what an ETF is, it's essentially a basket of stocks. Think of it like a folder, but it's against a certain instrument. So for instance, like SQQQ is an inverse to the NASDAQ. There are a ton of them out there. And what some people like to do is add leverage. So there are some that are triple leveraged ETFs. SQQQ is one of those. So that means that if the NASDAQ goes down 1%, SQQQ would actually go up 3%. And there's a lot of issues around them. I'm going to be making a video on them this week, but a lot of people like to use inverse ETFs to hedge their portfolio. So let's just say that you have $100,000 in a long-term portfolio and you have something like Amazon, Apple, Facebook, Google. And to hedge, you want to take about 5% of that or 6% of that, and you want to go buy SQQQ stock. Not necessarily terrible, but there are some downsides to it, which we're going to talk about in a future video. But that is one way that you could actually hedge against your portfolio. Now, the main way, which a lot of people, this is what everyone really wants me to talk about, but I wanted to get those beginner ones out of the way at first. The next is covered calls and really options contracts in general. And there's a couple of ways you can do this. The two main that we're going to talk about right now is covered calls and put contracts. So the first is a covered call, and a covered call serves a short-term hedge on a long-term position and allows the investor to earn income via the premium received for writing the option. However, the investor will forfeit their gains if the price moves above the option strike. So I will do a full breakdown video on covered calls. I have done one before here, but it was a very, very long time ago. But essentially, the way that a covered call works is that you have to own the shares first. So let's just say in this specific example, we have 100 shares of Apple. And with these 100 shares of Apple, let's say Apple is trading at $140 right now. And let's say that looking into the next 3 months, you think, you're bullish on Apple. You don't want to sell your shares. You really like Apple. But you think Apple will not close within the next 3 months above $170. So what you would do is you would sell a call for 3 months away, or whatever date you want to go, but we're going to say 3 months away. And that's going to be down here. I'm going to put this in bold letters so you guys can see. I don't have my drawing tablet today, but you would sell a covered call for 3 months away for a $170 strike. And let's say that your premium is, let's just say it's like $1,250. So what this means is that since Apple is trading at $140 right now, as long as Apple closes below the strike price that you sold at, for instance, $175, you get to keep your shares, which is great, but you also get to keep $1,250. So let's say that Apple actually went from $140 down to $130. You would have lost $10 per share, which would have been $1,000, but because you hedged it with a covered call, you would have made $1,250 in premium, which means you actually made $250 even though Apple went down. Now, let's say that Apple went up. It went from $140 to $165. Well, you ended up making $25 per share because you bought Apple at $140. Now it's $165, so $25 per share on 100 shares is $2,500. And because it closed below $175, you made a $1,250 premium. So You do the math, you made about $3,750. Well, I'm pretty sure that's right. I'm terrible at math, but I'm pretty sure that's right. So at the end of the day, that is huge. Now, what's the downside to a covered call? And this is what's important. Let's say that you have the shares at 140. You sell a covered call for 175 and Apple goes nuts. They release a new product or they have earnings that is double what they thought it was, something nuts. And Apple goes from 140 a share in 3 months up to 200 a share in 3 months. Well, this is where it gets bad because now you get to keep the premium of $1,250, but now you're forced to sell 100 shares or all of your shares of Apple to somebody at $175. Now, you still made the money from 140 up to 200 a share, but you have to get rid of your shares, which is one of the biggest issues. And I'm going to do a full video on this, so don't worry about it. But that is one way that you can actually hedge against your portfolio, is selling covered calls on long-term positions that you have. But for me, I would really sell them very far out of the money at a price you think the stock will not go above at all, because I don't want to go giving up my shares, especially if I have massive gains on it and I've been holding it for multiple years. Now, the last way is through put contracts. And many of you guys probably know what a put is. A put is essentially a bet that you make that you think a stock will go down to a certain price by a certain time. And I put here, as a rule, long-term put options with a low strike price provide the best hedging value. And this is because their cost per day to own is very, very low. Basically meaning the theta decay is very, very low. And although they are initially expensive, they are useful for long-term investments. So let's just say that you have 100 shares of Apple, like we said before. And that means that you have about $14,000 worth of Apple shares right there off the bat. Now, what you could do, like I said, is do selling a covered call. Or what you could do is just buy some puts for 6 months to 1 year out. So let's say you have $14,000 worth of Apple shares and you want to go and buy $1,400 worth of puts for next year. So you could take that $1,400 and you could go ahead and grab a, October 14th, 2022 $140 put. You don't want to go very far out of the money. You want to go up basically what we're trading at right now, because your delta is going to be high and your theta is going to be low. And I would never hedge like this with more than like 10%. I would never go more than 10% of your portfolio, because you're still dealing with theta decay at some point. It's just very, very low. So those are the main ways to hedge. And like I said, if you want me to continue to go over these, or you want me to do a deep dive on them, I'm already going to do one on ETFs and inverse ETFs and explain those to you, go over some different types of things with TQQQ and SQQQ. But if you want me to go into gold, crypto, bonds, inverse ETFs, how to, hedge with a covered call, how to specifically hedge, and go over some examples with put contracts, comment down below and let me know, guys. Thank you for all the support. Truly means the world to me. Hit the like button, subscribe to this channel, and I'll see you guys next time. Peace.